an ETF. They provide a service, and then they're going to make a fee, and they're going to sell it down. Same with exchanges, futures exchanges. Same with Grayscale. So that just translates to a lot more interest from institutional players that don't want to be exposed to Bitcoin, but they want to do something better than like 5% from a junk bond, or even worse from a... And I think the size of it now, it's a lot harder to have that kind of drawdown. Touch wood, everyone can be made an idiot by saying particular things and then doing the other. Yeah, but there's a lot of weight in the system. A lot of it's a huge amount of capital. It's not like 2017 where it was light and you could push it around. And there's different demand and supply equations in the system now. And so like with the advent of futures markets, I think it's going to make it very difficult for us to have this sort of FOMO, mania phase and above top, because, you can short this thing now. And so as this thing's going into overheatedness, it's very incentivized for you to bring in shorts into the system. And you're not even trading. You can just do the market neutral cash and carry trade. I'll buy some Bitcoin and I'll short it. And as it goes in a FOMO, I collect the massive demand for funding long positions. I'll provide the other side, and that'll cool the thing off. And like what we just saw in the maybe February to May zone, where it had a sort of a distribution top, rounded top, and then a mini bear. Maybe that's more of the shape of the future, a rounded top, mini bear, and then another progression up, and we just keep doing that dance. But I've talked about, at least in the past many times, that if we continue like that in this kind of new world of very developed futures markets and ETFs and so forth, that will probably just continue like the way we have. We have different demand and supply with, shorting. We've got a lot of selling down from different infrastructure players. Like, if you think of miners, they're an infrastructure component, and they make money, and then they sell it to realize that money to pay for their OPEX. And the same thing with an ETF. They provide a service, and then they're going to make a fee, and they're going to sell it down. Same with exchanges, futures exchanges. Same with Grayscale. So it's all these different demand and supply effects now, and it's a new game. We didn't have that in 2017. Miners were the only game in town, and when they halved, like this step change built a bullish run, and then we went into FOMO and mania, and there was no shorting to be able to, no real way you could short and cool down the heat of that run up. So yeah, it's different. I think it's very different, and I've been calling this the last cycle. As in, a bit like Michael Saylor, it's going up forever, Laura. It just keeps going and finds its price discovery in a random walk. We did a 50% pullback. You may call that a bear. I may actually think that you may have called that a bear market now, like a mini bear market, like recovers in 3 months, rather than the standard Bitcoin bear market, which is like a 9 months or more and 85% drawdown. Maybe that is a new bear market, and we just had our first one. Yeah, so it's different. There's definitely demand. There's billions of dollars that went into it. And like it's regulated, right? So all of that demand ends up on the CME, which is a futures cash settled market. And they have limits to the CME. So like, even though there's maybe a lot of demand, there's only a certain amount of long positions, which is what you're buying. You're buying a long position on Bitcoin when you buy the ETF. There's only so much that you can buy, right? Because they have limits because it's regulated. And so, but, as that grows, what happens is what we call contango, which is the price that the futures contract sells above the spot price. That contango, that increase in value on that futures contract, starts to push up more. And as that pushes up more, it's very attractive if you're an institutional fund or anyone really that wants high yield on their US dollar, and not be exposed to the volatility of Bitcoin or any of these emerging risk-on assets. They go, look, I just want good yield. And so typically we've had 15, 20% annualized yield by shorting the futures, actually taking the CMEs, or the futures ETF through their CME and taking the other side of that paper contract and buying Bitcoin, so you're fully hedged because those two eventually settle together once it expires. But effectively, the yields from these guys doing the cash and carry, the yield making play, it becomes very attractive. Instead of going 15, 20%, you can go higher, right? Like back earlier this year, I think the cash and carry trade was around 20, 25% on the CME when things was really right bullish. The cash and carry trade on Binance and FTX and those guys were even up to, I think, the 30 to 35 equivalent. There was like a 5 to 10% higher yield because I think a lot of the funds that were playing that game were actually regulated players on the CME in the US, and they were taking the yield. But now we've got this futures ETF coming in, and they're pushing that contango up, and there's more yield to be had, and that just translates to a lot more interest from institutional players that don't want to be exposed to Bitcoin, but they want to do something better than like 5% from a junk bond, or even worse from a proper treasury bond. So I think that just draws more and more money in, and again that's going to provide dampening on the that those kind of FOMO we get in the bull markets traditionally. So it's just it's a different game now. It's more measured, a little bit slower, much more capital involved. Really interesting if you're looking at bigger games like macroeconomics and macro finance rather than just the Bitcoin has really crossed that chasm now to impact traditional finance very clearly in this year, from going from very early to now really there. And I remember Novogratz was saying was it 2017, the herd is coming, but we had no infrastructure. Like there was not good custody solutions. There was all sorts of things that needed to be ironed out. And in the bear market of 2018 and 2019, all that stuff got built. And now 2020, 21, they're coming because it's ready, and it's getting more and more interesting. And like the volcano bonds, another, that's people doing really interesting things with Bitcoin right now.